Aloha, this is Netra Halpern with Netra's News. So we've got Ann Jenny here in the studio today. Ann Jenny, I'm very excited to have her with us. She is a former federal banking regulator with the Office of the Comptroller of Currency. And she currently is a professor, instructor at UH Maui, University of Hawaii, Maui. And so, Ann, everybody's wondering, what is this recession? Why are we in a recession? Why are people losing their homes? Why are we having so many foreclosures? Why did we bail out the banks for all that money and yet we're still poor? People are still losing their homes. People are still having trouble getting jobs. What's going on with the economy?
How many hours do we have here? Even in an entire semester, I don't think I could answer the questions. There's a lot of factors that go into the entire equation. So tell you what, break it down. Give me a small question to start with.
Okay. So the bank failure. Why was there a bank failure? Was there a relation to subprime mortgages and the bank failure?
All right. The banks failed because they are making highly speculative investments without adequately assessing the risks of those investments or effectively protecting themselves from those risks. All right. Because we have broken down the barriers with the failure of the Glass-Steagall Act, we don't really have the barriers that we put in place after the Great Depression in the 20s. We don't have barriers between what used to be separate merchant banks, what used to be separate investment banks, what used to be community banks. So all of our lending is done by a small group of banks now. And in order to get the greatest return, they want the most speculative investments, which of course are the most risky ones. And because we don't have those firewalls that protected our community lending from the speculative and highly risky securitized lending, the community is now taking the risks that only those that were most able to monitor those risks are. Everyday people are taking those risks. When I take out a loan now, what I'm taking out is actually a small piece of a securitized loan that's going to be sold and sold and sold again. And it's the speculation in those sales, in those stream of payments that my loan represents, that actually are what drove some of the banking failures. So it wasn't so much the banking failures as the failure of the Wall Street risk managers.
So basically, let's say I had bought a home between 2003 and 2008, because that's what my understanding of when all these securitized, when it was at its worst. So instead of me actually buying a house, I was actually buying a security many times. And what one of my colleagues who is a paralegal has said is that instead of making the loan, that many times the banks were actually, or the mortgage brokers
So Debbie,
were actually...
what is your experience of the economy in the last couple of...
Well, it looks like we had a little bit of sound from our woman on the street, but we'll get back to that later. So just know that Woman on the Street is coming next. So anyway, so as far as securitization, so that many times instead of the banks and the mortgage broker actually getting a mortgage, let's say you're Ms. Homeowner, you come in, you say you want to buy a house, you sign up for a mortgage, that actually that mortgage has been sold to Wall Street before you even signed your name. And so even though you think you're just buying a house and getting a mortgage, you're actually buying a security. And they're supposed to be, according to Securities and Exchange Commission, they're supposed to be, and so, like you said, those that are able to take risky loans. Like if you gamble on the stock market, you know you're gambling. You can't come crying and say, well, I bought stock and it went down, because it's the stock market. But when you're buying a home, it's not supposed to be that risky.
And you're right. What happened was that in order to get a mortgage, somebody has to fund that mortgage. And the people that fund mortgages fund it because they want a return on their investment. By securitizing mortgages, what we've done is we've taken the funding piece of it away from banks funding loans to the securities bundlers funding the loans. And what they were demanding was a better return. Now, interest rates are what pays for risk normally. So the higher the risk, the higher the interest rate. So what they were willing to fund was only the higher risk, high interest rate loans. They weren't willing to fund the more secure. Between 2003 and 2008, you couldn't have gotten a VA loan because nobody was willing to fund them. They were very low interest and very low risk. So even if you were eligible for one, you couldn't find one on the marketplace because the funders out there weren't willing to fund those particular sets of loans.
And that's an interesting point that you bring up, because some people have said, well, it's because you know, the government was trying to give loans to all those people, and it's because people were buying homes that were above their means, as opposed to it wasn't on the demand side, it was on the supply side. It was on the bond makers, the people that were bundling all these securities together, all these mortgages together to make securities. They were basically putting the word out on the street, or i.e. the mortgage brokers and the banks, give us more, give us more, give us more. Do we care if they're high quality? No, just give us more, give us more, give us more.
And so you slightly misspoke there. The demand for low interest rate, safe mortgages was not there.
Yeah.
Low interest rate, low. So the demand from the dealers, the demands from the securitization, the demands from the bundlers was, give us these high interest rate, high risk loans.
Right.
And part of it was that there was such a tremendous volume. And with the consolidation of our banks, you don't know who you're borrowing from anymore.
Yeah.
You're borrowing from an entity that, you know, one of your phone calls goes to Texas, another one goes to South Carolina, another one might go to North Dakota. And all in all, you're making a borrowing not anymore from the banks, but from brokers who are the middleman between the demands of the securitization market and the people that are trying to get funds to buy a house.
And I think when I said demand, I meant demand as in home buyers, as opposed to demand as in Wall Street, that demand, that it was fueled. And I think that's what I want people to be aware of, and what I want to get across to people this evening is that the problem, it was not the borrowers. The problem was not people buying more house than they could afford. The people bought houses that they could at that moment afford. You know, even with the stated, people don't buy a house to then, you know, give up their old place and, you know, change their address and buy drapes and move their kids, and they don't go through all that to be evicted, just like people don't, in general, buy cars they can't afford. People want to be safe and secure. So that it was the demand and the creation of this fiasco. It's just that I want people to be clear who created this fiasco, who is responsible, and then what the measures were or were not taken by our government because of it. I just want to have more clarity about that for the general public.
It was a confluence of so many different forces. The attitude on Wall Street of bigger and bigger and bigger is better. The more returns. There was a push. If you're going to earn $1 billion because you have created these mortgage loan pools that are paying these high interest rates, or are you going to be content to earn only a couple of $1 million because you've played by the rules? I mean, that greed was what drove a lot of it. The speculation in the housing market. Anytime you've got a bubble in any kind, whether it's in the Silicon Valley type stuff, the high-tech stocks, whether it's back in the
The tulip.
That's exactly where I was going. The tulip bubble in Holland, 15 or 1600s, you know, where everybody was selling madly these shares in tulip bulbs and things like that, looking for the elusive black tulip. You know, all of those bubbles are driven by speculative greed. They're not driven by underlying value. And the other piece of it is we've shifted away from a market where you go out and you buy a house and you take out a simple loan to buy that house. We have so many layers of fees and charges and brokers and sales costs and things like that. It used to be as easy as buying a car. You know, you would go in, here's your car, and, you know, tax, title, and license and transfer fees, somewhat of that. Now you look at a HUD-1 statement, you can't even get all of the details until you sign it. And we're paying thousands and thousands of dollars to people whose only job is to figure out ways to generate more fees, essentially. So and then every time a house is sold, you have to try and recoup all of those fees. So a lot of the rise in the prices was not driven by increases in value. It was driven by people trying to recoup all of these fees and charges that have gotten added on, which, you know, they would pass on to the next buyer. So even though, you know, your house may have sold for more, it wasn't because of appreciation. It was because of both speculation in the market and all of these additional fees and charges.
Okay. So, okay, there was a depression.
Right.
And then people freaked out and said, oh my God, we need to have some regulation to keep the different types of lending institutions separate, so that high speculation and regular commercial and retail lending is not together. Okay, so we had the Glass-Steagall Act. And then over time, presidents of both the Democratic and the Republican Party gradually got rid of that. Who do you think
well, the presidents didn't get rid of it. They just signed the bills that Congress passed.
Yes. So who do you think there was a banking lobby that...
oh, absolutely.
Okay.
I mean, by limiting the amount of speculative investment, we limited their possible returns, right? And of course, it's like what I said about the brokers on Wall Street. If I could make $1 billion by doing far more speculative investment, then I would do those type of loans or those type of investments. If I'm trying to do you know, just everyday community banking, the greatest return I could get is probably about 6%.
Yeah.
You know, and you know that's not going to make me the multi-million-dollar paychecks.
And was there not a woman named Brooksley Born? I watched a show about her. She was she's a commercial banker, a professor, I think at Harvard, and she was a friend of Hillary Clinton. And when Bill Clinton became president, she evidently went to visit him to possibly be Treasury Secretary, but evidently he found her boring. And so he instead gave her the consolation prize of putting her as the what was that? The Future Commodities Exchange Commission? Is that
the Commodities and Future? There are a number of different regulatory entities. The commodities market is a very distinctly different market than the securities market, which is a very different market from merchant banking. There's the Federal Reserve, there's the Office of the Comptroller of the Currency, there's the state banking regulators, there's the folks that regulate credit unions, there's the folks that regulate securities. And so we've got this whole basket of regulatory agencies. We lost one regulatory agency that was folded into the Comptroller's Office, the Office of Thrift Supervision. Even after the banking failures of the 80s, that was still kicking around. They finally folded it into the OCC about a year ago.
Really?
Yeah. So, but
after the banking crash.
After the savings and loan crisis in the late 80s, in the early 80s, the Office of Thrift Supervision was very much hamstrung. but it still existed for another almost 30 years until it did get folded into the comptroller's office. You know, the Federal Deposit Insurance Corporation has examiners. They're trying to make sure that their insurance risk is managed. Each regulatory agency looks at a different set of issues and books.
So let's hear the Women on the Street interviews, and let's just hear what some people that I discussed this with at Safeway and at their shops thought.
Okay.
It's been tough, really tough. Like you said, I'm a realtor. My husband's a builder. And, you know, the economy turned and it was really hard. He got laid off, and I'm a typical story.
Yeah.
You know, that's what I'm hearing every single day, really across the country. But, yeah, it's been tough.
And some economists are saying that the recession is over. Is that your experience?
I don't know. I wish I had a crystal ball, because people ask us that all the time. It's getting a lot better. I mean, I'm seeing huge improvements. The housing market is moving. Very, very different than it was more than 6 months ago. We're looking at a completely different market. But whether it's over or not, I don't know. I mean, I hear that there's more foreclosures that are coming. I don't know.
Hi, Erin. I'm Netra, and we are talking to people, and we have a special segment for kids that we want to know what kids' views on things, because we think it's really important that the views of kids are expressed. So, Erin, has the economy affected you and your friends as far as, you know, not being able to do stuff you like to do, or feeling afraid that, you know, your family's not going to have what it needs, or how's it affected you?
It's definitely affected us because, you know, families are not without a lot of money anymore, and like since all the prices have gone up, it's become harder and harder to do certain like activities that you want to do. Like, for instance, if you want to go to the movies, a few years ago it would have been great, but now it's like just families are struggling through that, and it's just become more difficult.
And how do you feel? Has it affected your view? I mean, it started when you were kind of young and maybe not thinking about these things, but has it affected your view of your future or your career prospects or your ability to go to college?
Yeah, well, right now I'm definitely trying to like aim my way toward college, and I've had to think a lot more about like financial aid and getting grants, and it's become like really, I don't know, just hard to
hope.
Figure out what I'm going to do, since, you know, the economy has just like slipped away.
What are your career goals?
Well, right now I'm wanting to get into graphic design. Yeah, that's a main interest for me.
And I assume on like computers.
Yeah. Mm-hmm.
Well, that's obviously a very important job. I have a graphic designer I couldn't live without. Well, I wish you the very best of luck.
Well, people have more choices when they have more money. In fact, there's a study now that really says that people are happier when they have more money.
I actually have been quoting that study, that it was that money does buy happiness up to around $70,000 or $80,000. Basically, once you get middle class and you have your basic needs met, it doesn't go up from that. But not having your basic needs met will depress you.
I think even millionaires will say that if they make more money, they're happier.
Okay, well then that's a different study than I read. Okay. But absolutely, maybe there's like a huge spike at, you know, once you get your basic needs met, then maybe it inches after that.
Yeah, I think what we'll see in the next couple of years is real big expressions of dissatisfaction, like we're seeing right now in Greece, where systems are falling apart. I think we'll see social movements start to emerge about the inequality of wealth in the economy.
What do you think is the effect of the foreclosures is on everyone, on the whole market, on the economy as a whole?
Oh my goodness. I have to really think about that answer. You know, I think it's really frustrating for people in a particular neighborhood when they've got a half a dozen foreclosures in their neighborhood. It's definitely affecting values, though appraisers are taking that into consideration when they're looking at value. I don't know. That's probably the best answer I have.
So you're just holding off. I mean, waiting. You're in a wait and see. You're just going to see, you know, how much will this affect the overall value of real estate in various neighborhoods?
Yeah, it's definitely affected the value already. I don't know long term how it's going to affect, you know, from this point on. I don't know.
It's just really difficult. And a friend of mine also, who is going through the same thing, they raised her interest rate because she wasn't making as much money. She has been paying every month. And then she had, when she was trying to save her home, which so far she's been able to do, she had to give them her report on her earnings, and they raised her interest rate.
So for her taking the effort and the good faith measure of speaking up, communicating, and disclosing, they penalized her.
Absolutely. Doesn't make sense, but that's the way it is. So I don't think that they really care.
Well, that is certainly a very discouraging story. So, you know, bear that in mind before you call the banks.
Well, or know what you're doing before you call the banks. I think to be forewarned is to be forearmed.
As a sign of the times on the level of unemployment, you were saying that it's there's a huge group of people, pool of employees to choose from, that you get, somebody comes in almost every day.
Yeah, I mean, at least one person a day, probably 2 or 3, to be honest. And I mean, in a way, it's a good thing for us because we get a huge pool of employees to choose from, really qualified staff. We have a great staff now, put up a great product. But I mean, it's just because there's so many people looking for work. It's kind of a really sad story, actually, that all these people can't find a job. And I mean, most of them are so qualified too. It's amazing. So,
you know, the stresses that come out in families come out because people can't move out. They can't separate if they're in a tough situation and want to separate or divorce.
Here I sit all alone and I stare at the clock. I've been waiting for that moment when the sheriff will knock. Like so many others manifest in their dream, convinced by some professionals in some great Wall Street scheme. For the banks and the brokers, I had papers in hand. I had tax returns, pay stubs, maps of my land. Never had a loan. The bank I debated. Don't worry, they said. That's why we ghosted. I gave onto them my bank statements piled tall. Oh no, said the bank, we need nothing at all. I thought to myself, well, how could that be? I didn't know about the paper feeding frenzy. Like so many Americans now living in shame, I was unaware of the securitization game.
So, do you have any comments about what people were saying?
Well, I do have to agree that we are creating jobs. The problem is we aren't creating jobs that pay a living wage. And jobs that don't pay a living wage, the cost of living has to be paid somewhere else. So we have more and more people relying on subsidized housing, subsidized food, and you know, our food banks, and you know, moving in with relatives and things like that, just to try and make ends meet. Even though they do have a job, you know, people working 2 and 3 jobs were common here in Hawaii, but at least those jobs paid. Now, you know, it's really difficult to find even one job that pays a decent wage. That's the biggest part of that. Part of the issue with the regulatory reforms, when the woman was talking about getting her interest rate raised just because her income had gone down, that would have been illegal under the old rules. A lot of the banking rules were there to protect the consumer, and they've gone away, which means that the mortgage servicing agencies can play those kinds of games.
Do you hold out hope for Elizabeth Warren's Consumer Financial Services
The Consumer
Bureau?
Financial Protection Bureau.
Yes, Consumer Financial Protection Bureau. Do you think, well, first, I'm sure she would make everything great if she had the power. So do you think, basically, I guess, I heard that President Obama, he put her forward. There was a lot of resistance, I think, from Republican congresspeople. And he's kind of backing off, do you think, well, that's kind of asking you to look in a crystal ball, but I mean, I guess the key is, will she have enough, will that organization have enough power to actually do something? Because I'm sure she would fix everything if she could.
Part of the issue is the funding. Congress doesn't have to get rid of her. They don't have to get rid of the agency. They just have to not fund it, which is exactly what they're doing. That was one of the first items on the chopping block, was any of the regulatory agencies.
So let's get some perspective here. Can we see the numbers, please, the statistics about the Wall Street situation? Okay, so we've got right there, 1.4 trillion. That's the number of the amount of the subprime loans themselves. So 1.4 trillion. Then you've got the bailout of the banks, which is 13 trillion. So that's almost 10 times as much. Mm-hmm. So if these are the actual value of the loans, not even those that defaulted, but the actual value, why was the bank given 13 trillion? Actually, I'm not asking a question yet. And then the approximate amount of all of the money wagered worldwide, that includes like countries like Iceland, who, that's a really sad story. You got to see the movie Inside Job. It's an excellent movie. But anyway, 140 trillion. So you've got 1.4 trillion, 13 trillion, and then 140 trillion that was actually wagered on these little teeny mortgages. So that's why I want people to come away from this show tonight understanding that it's not the borrowers that created this problem. It was the speculation. Mm-hmm.
Well, look at oil prices right now. The cost of drilling for a gallon of oil has not really changed that much, not in probably 10 years. But we've seen our oil prices skyrocket. Part of that is because the prices that we pay at the pump are not set by the cost of the actual cost of drilling for a barrel of oil, but what a commodities future contract is worth.
Exactly.
Okay, so because of the unrest in the Middle East, because of the uncertainty about the marketplace, oil futures have skyrocketed. Commodities started out as a way to help farmers, or commodities trading as a way to help farmers get the money for their crops ahead of time. So they would put out contracts for delivery of 100 bushels of grain or 1,400 pounds of pork bellies or whatever else. And then the guesstimate of what that would worth based on, what did we expect the weather to do, that was sold in the commodities market. Because this has become a worldwide issue, and you pointed out Iceland, and another gentleman pointed out Greece. Ireland is another loser in this game. Those prices get bid up and get bid up and get bid up. So you've got the commodities piece there. Then you have people who are betting on the movements, all right? They're shorting things, saying that, or they're selling long or selling short, but generally what's caused the problems now is the short sales, which again distorts the marketplace. So you have a small amount of mortgages that become a big pool of mortgages that people are trying to guess, well, is this bubble going to be moving forward? Or is it going to be getting bigger? Or is it going to explode? All right? We don't know. But because there was so much uncertainty in the market and everybody was so rah-rah gung-ho saying, oh yeah, it's just going to keep going and going and going, they bid up those prices way, way, way over the value of things. So it wasn't the mortgages that they were paying off, but the people that had bought the secondary products and those people who had insured those mortgages, all right?
Right, exactly.
Every single one of those pools carried a loss insurance piece. Not just the Fannie Mae and Freddie Mac insurance pieces that you talk about when you get a mortgage, but remember, one of the first names in the failure system was American Insurance Group,
Right.
AIG.
Exactly.
They lost because they had been insuring these loan pools, which all of a sudden started collapsing under the weight of the speculation. So it wasn't the mortgages so much
Right.
as the collapse of the speculative market that drove those things into the ground. And that's why this multiplication of prices that you showed in your in the statistics there, that price inflation, every time you take it up another level, it's essentially like multiplying it by 10, which you exactly showed in the video there.
Yeah. And then one thing I didn't mention that was also on the statistics, if the government, the U.S. government, the federal government had taken that same $13 trillion, they could have paid off everybody's mortgage, not subprime mortgages, not anything, just everybody's mortgage in the entire United States. They could have bought homes for people that didn't have homes. They could have bought health care for all of us. So in other words, they could have made us all sitting pretty. Every single citizen in this country would have been owning a house for paid off. And instead, they took that money, gave it to banks, who then didn't free up capital. I mean, it wasn't like then they were out lending it. They stopped lending. So basically, many people feel very disappointed that we, the people, Main Street, were not protected, were not taken care of, and the banks were protected and taken care of. And there was this article in Rolling Stones called The Wives of Wall Street. And what they talked about is with the bailouts, it started becoming these non-recourse loans, which is loans that, well, correct me if I'm wrong, but basically that you, heads I win, tails you lose. Basically, if the loan went well, the person could then take their winnings and walk away. And if the loan didn't go well, they just say, and just walk away. And they started giving them to more and more people. And then this article was about Christy Mack, I think she's the wife of John Mack, what's his first name? Anyway, Mr. Mack, who is, I guess, head of, is it Goldman Sachs or one of the big...
I've lost track at
But
this
anyway,
point.
one of the major brokerage houses. And she and one of her girlfriends did alternative medicine, which, you know, I totally believe in and is a great cause, but the way it was done was not fair. So basically, you know, and then they all became bank holding companies, and so there was...
You and I should have become a bank holding company.
Yeah, why didn't we? What were we? I didn't have our eye on the ball, but it was like there's this thing called disaster capitalism, and what it is that corporate entities who take advantage of whenever there's a disaster to make money. Now, there's even some people who say that they create disasters because when people are in panic and fear, they're vulnerable, and that's when you can hoodwink them, basically. And so what happened right after the bailout, I read a book called It Takes a Pillage by Nomi Prinz. I don't know if you got a chance to read that yet, but it's an excellent book. You got to read it. Nomi Prinz was a managing director at Goldman Sachs, and so and then she became a journalist, so she's very, very aware of what's happening with this. But basically, after the bank failures, there was all this crisis, and then with the working together with the Treasury Secretary and the Chairman of the Federal Reserve, they did all these fixes that were still sucking more money to the banks and less to the American people. And that's why we're in a recession, and that's why people say it's a jobless recovery, because, yeah, if the super rich have more money, whatever, what I care about is the 99% of the people, can people pay their bills and lead a decent life?
Was there a question in there?
Maybe not. So let's hear the rest of the rap, mom foreclosure rap, the mom's foreclosure rap. I did the first stanza in there, and so let's listen to that, or let's chat until that starts.
She's on the monitor there.
Okay, so I guess.
All about finance I learned back in school. but nothing was taught about some mortgage pool. The economy all bad and about to go bust. I realized my loan, it was due to adjust. The bank reassured me when my home I did buy. We will refinance you, they said, oh, but that was a lie. I remember those words with some angst and a frown. My home underwater, completely upside down. I called up my bank to get some justification, and I asked him in fairness for a modification. You're not in default, your payment's on time. In order to help you, you must be 4 months behind. Americans were taught into our institutions to trust, so I listened to my bank and I did what I must. So with credit now ruined and I called to apply, I was put on hold till I wanted to cry. After waiting forever and throwing a fit, I was given a list of documents to submit. So I gathered up everything and I faxed them my stack. And so many, many months I finally heard back. The response from my bank, well, it couldn't shock me more. There was a notice of default that was nailed on my door. Your foreclosure moves forward regardless, they said, and your modification now has yet to be read. The day finally came when I was assigned Agent Clarence, and the bank put me on some plan called forbearance. 3 months I paid more than before, but those uneasy feelings, man, I couldn't ignore. 3 months had passed and my payments on time. What the bank did next, oh God, it should be a crime. The bank wants financials and I asked them, well, why? They answered, because you no longer qualify. Well, what they said next, God went right to my core. In order to qualify, I must pay $10,000 more. So I sold many things, big, medium, and small. The $10,000 booty, the bank got it all. You know, I did all I was asked in my home to save. I prayed every night, and I tried to be brave. I never imagined in the end I would fail, but I knew it had happened, a notice of sale. The bank gave me a loan that they said was a must, and they promised to change it before it adjusts. Hey, no courtroom, no judges, no madams, no sirs. The money I'm gonna owe is to a machine called MERS. My loan was bought many times, and God, I don't know the source, but I will never find out who's holder in due course. I loaded my cat, dog, and kids in the car. I took the last cash from our small cookie jar. I felt so alone, frightened, sad, and so blue. If I could afford some lawyer, you know I would sue. But alas, the bank won. God, their back gets a pat. No attorney for me, they were counting on that. Hey, now read all about it and get really pissed. B of A pays $6 billion to investors on their list. Investors got their cash out of those toxic mortgage pools, while I lose my home and my son can't go to school. Investors, they're not deemed to know the reps and warranties, not required to notice dotted I's and crossed T's. Borrowers, they call us, you know, folks like you and me. Servicers say we're responsible, we signed the 1003. Investors, they got paid, and you know, no one disputed. Homeowners speak up and we get prosecuted.
Okay, so one thing that she just said about if I had money, I would have sued, and I read an article about Goldman Sachs sold some investments to Omar Gaddafi, and he then they promptly lost 97% of his money, and that it was like, I don't know, billions, and so he threatened to behead them, you know, the normal thing. And so, of course, all of the bankers in Libya at the time got their bodyguards, and then they, you know, shuffled back home. And then they went and they started offering, well, how about this, and how about this, and how can we ameliorate it? And they didn't give that same kind of star offers to any people that didn't, threaten to behead them. So I think maybe, I'm not advocating that, but I'm just saying.
Well, Donald Trump always says borrow big because that makes the banks your partner. Makes it much harder for them. He's been in bankruptcy how many times now?
I don't know how many.
Several,
Okay.
But he comes out of it every time smelling like a rose because the banks do everything they can to try and help him out of it. He's an example of why too big to fail is such a poor way of doing business.
And okay, let's talk about modifications.
Okay.
I know several people that shop owner friend of mine and her friend I also know, and I have several friends, and pretty much everybody says the exact same thing. I have given the exact same paperwork 10, 15, 20 times, the same paperwork, and the bank continuously loses it. And my paralegal colleague said that her theory is because the banks are trying to string people along so they get past the statute of limitations, and then people cannot sue them.
That could well be. I don't know. Not being in the industry, it would be hard to say. That's a possible reason. When you take out a loan now, if you go buy a car, they spend more time trying to sell you a particular loan package than they do trying to sell you the car, because you're no longer seen by the financial industry as just a simple borrower. You're seen as a stream of payments. Right? And those payments are something that they can bundle up and sell on the secondary market. So if there's some sort of interruption in that, they're not able to sell it the way that they would. So it's also to their benefit not to modify things, not to change things, because then they have to pull your stream of payments out of that big pool of payments that has already been sold on Wall Street.
And I think that's an excellent point that you're making, is that many times the investors, and that's what is really important to remember, is the investors and the banks are not the same entities. The investors are often, New York City Fire Department pension fund, or, Maui County or, state of Hawaii. Both of these entities bought securities back in 2008 or 2007. And then they got caught in, I think it was Merrill Lynch was one and Citigroup was another, where there was some funny business going on where the brokerage company was representing that the securities were more liquid than they were. So in other words, there's securities fraud, there's all these mortgage fraud. And the other thing I wanted to mention is investments, the investors for these mortgage pools are, as I said, they're usually these entities. And these entities are required to only purchase AAA rated securities. That's because, you don't, as the pension plan, you don't want to lose all their money. And there's Standard & Poor's, Moody's, and then Fitch's. Those are the primary rating agencies. And they were rating almost everything AAA. And then they were taking the ones that were not AAA, and then they were taking the best of those in AAA. And so they're like repackaging and repackaging and repackaging. And one reason I think they were doing that is that they were paid by the actual the investment funds, that the investment funds paid to get themselves rated. So there's kind of a conflict of interest there. And so when you were working, and I guess back to the whole issue of regulators, and that's kind of the bottom line problem, is everything about our lives are regulated, whether we build an attic or not, whether we do, an addition on our house, driving, we have to get our license, even, with No Child Left Behind, even 5-year-olds are regulated. They have to be taking these tests. So everything about our lives are regulated, except for the finance industry, which has trillions. I mean, people are arguing about, well, should we cut spending in welfare? Should we cut spending in war? Should we cut spending here? That's all manini compared to the dollar amount that is being lost on Wall Street. And that's what people aren't really understanding, how big that is. And that's why our country is in a recession. That's why people are getting poor. And then the other thing that Elizabeth Warren, actually you had me watch a video about a lecture that she gave, the coming demise of the middle class.
The coming collapse of the American middle class.
Right, and this was done in, I think,
2007. It was a lecture that she gave at Berkeley.
Right, so before it started falling. And what she pointed out is that then in the last, it's like 20, 30 years, that, like, think about it. When we were kids, only one parent had to work, and then one adult could actually support an entire family. And then women said, oh, we want to work. And obviously, you know, we should have that right, but it shouldn't be required to support a family. And so as more people, all these women joined the labor force, the wages stayed the same, and the costs, inflation, and that's handled by the Treasury, right? That's who. It isn't the Treasury, the U.S. Treasury, the Federal Reserve.
Okay.
I'm sorry, she's the expert on these things. The Federal Reserve is what is trying to modify.
The charter of the Federal Reserve calls them to promote growth, help control inflation, and ensure a low unemployment is supposedly the charter. Now remember, the Federal Reserve is not a government entity.
And I had somebody get really upset at me on Facebook by saying the Federal Reserve is a private bank. But you, Ms. Federal Banking Regulator, are saying the same thing.
Exactly. The U.S. Treasury is a government entity. The Federal Reserve banks are a set of 12 banks in 12 regions of the United States that have taken over what is normally the role of a central bank in other countries. And central banks are the banks that are actually the government entity that is a bank. So they're very secretive. We can't look at their books. They're privately owned.
Didn't that change in the last year?
Not really. No, they're still pretty secretive.
But wasn't Congress allowed to start pouring through their books? I know that they were looking at things. I know that I've been reading articles about that. You're saying they're still not allowed to look at everything, or what's the problem?
It depends on when Congress looks at something, they have to put out a list of exactly what it's not like the Federal Reserve banks opened their books to Congress and said, go look at whatever you want. Congress would have had to send them a list of, we want to look at this, 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 and this.
And they might not think of the things in the places that it was hid. And if you were in charge...
If I was in charge?
And if you were in charge, what would you do so you're saying a central bank is different than a Federal Reserve. Would you change our system to one with a central bank instead of a Federal Reserve? And what is the difference?
The difference is anytime you privatize something, you give up oversight of it. All right? For example, in the military, when the cooks and the road builders and everything were all members of the military, they were all subject to the Uniform Code of Military Justice. They were all part and parcel of the same agency. We had all sorts of people that were looking over their shoulder all the time. The idea of the Inspector General was a real force in making sure that things were handled properly. When we started privatizing that, we lost that. Now, you know, Halliburton can get away with enforcing unfair labor contracts.
Some real ugly things.
Some really nasty
like women
stuff.
can get raped and they can't even...
They can't sue.
They can't sue. I mean, that's not American.
You know, I've had friends electrocuted because of poor work done by I guess it was KBR and things like that. So what happens when you privatize things, instead of having, you know, the Seabees or Red Horse, depending on which branch of the service you're in, who you work with and you fight with and you talk to all the time, you've got some private contractor out there who's saying, well, for a profit, in order to take care of this, you know, I'm going to cut corners everywhere I can so that my bosses can make a profit.
You just made me think of private prisons, but that's a different show. So look forward to that. But basically, the profit motive. And to me, it's like, what is government for? And the way I look at government, my theory is it's for collectivity. You know, like everybody, we need roads. Everybody's not going to build their own roads. We need utilities, and I know many utilities are private, but then we have the PUC to monitor them. And so we need things that are collective. And in my view, it also should be about bullying, about stopping bullying. And that's what I see the regulators for the financial industry is like, and you've talked to me at previous times about credit card, how it used to be that, 14, 15, 29% would be considered usury, and now they're getting away with it. And we need
The mafia's gone legitimate.
Yeah, basically, there's a book, The Best Way to Rob a Bank is to Own One. So, so we have all these issues. What can people do? I don't want to just, put all this information out to people and have people feel depressed and overwhelmed. I mean, I'll give my opinion, but what is your view? What do you think can help?
I think one of the best things we could do would be to understand that the regulators are not the bad guys.
Yeah.
Right? We're not out there to stop jobs. We're not out there to stop growth. I'm an adamant capitalist. I believe that people's self-interest does drive what we have. But you wouldn't have a football game between a junior college and a pro team, and expect it to play fair. The regulators are essentially the referees in the world of a capitalist system. We're the people that were responsible for pointing out when there were abuses of the system, when there were abuses of power, when the bullies were in charge. So the first thing I would say is to understand the difference between regulations that are out there to protect the corporations and to protect the big guys, and the regulations and the regulators that are out there to act as the referees for the rest of us.
Right.
And there's very different rules there. I mean, giving a tax break so that somebody can write off their yacht under a mortgage deduction is very different than a regulation that says that if you're going to adjust the interest rate on somebody's loan, you have to adjust it tied to a index that is publicly available.
Right.
That you can't just do it on some random basis because they lost their job.
Right.
Those regulations that we were so quick to get rid of were what protected us from the abuses that have led to the crises that we have now.
And what you're talking about is publicly available information. A friend of mine was trying to get a more modification, and they did an NPV, a net present value, on her home to decide whether it was in the best interest of the investor to give her a modification or to foreclose. And this is an individual who actually could have sold her house and was advised not to sell her house by the bank. They said they'd give her a modification within 3 months. 2 years later, they haven't given her one. She missed the window of opportunity to sell her house, rent, and then now buy a house mortgage-free because of this whole modification scandal, or shambles.
It is a scandal.
Scandal, shambles, travesty. But basically, lack of transparency. The NPV, I mean, it's a bunch of information. It's a bunch of numbers. They decide what is in the best interest of the investor, and they wouldn't give it to her.
Yeah, well, net present value, fair market value, that should be that should be something that I could pull up. And there are sites and things where you can look at it. Anybody who's ever been a realtor knows how to find out the current value of a property. But do we know what information that they were using?
It wasn't just, comparables was part of it, but the part of it is, okay, how much equity does she have? What is her credit worthiness, et cetera,
So they weren't looking at net present value of the house, they were looking at net present value of the stream of payments.
Exactly.
Yeah.
Exactly.
Goes back to what I was saying, is that the financial industry no longer is interested in what it is you're purchasing with a loan. They're interested in you as a stream of payments.
Exactly. And the other thing I wanted to point out is the Glass-Steagall, there was the Depression, then there's the people freaked out, then they instituted the Glass-Steagall Act, which separated these various branches or types of lending institutions, basically to create stability and to take away
They
risk.
separated out the various types of investment opportunities.
Right.
All right.
Right.
A bank can invest in a mortgage. To a bank, a mortgage is an asset. A loan is an asset. To a securities dealer, securities are their assets. They're selling different things.
Right.
And by keeping those separate, and by really understanding the various risks associated with the various products, now it's no longer the value of the loan. Nobody wants just simple interest, because one of the other things we gave up was it used to be interest rates were fairly well fixed. We started letting them float in the 70s, which led to the thrift, the savings and loan crisis in the 80s. But we've also taken away a lot of the other controls on the system, so that people aren't making money on just interest anymore. They're making money on the fees and charges.
Right, exactly. And the other thing I wanted to mention is that basically the banks and the investment houses have very, very strong lobbies. And they have been lobbying the politicians. And it's also because of, we have privately financed campaigns. So I wanted to talk about public campaign financing. That basically, instead of it being one man or one person, one vote, it's become $1, one vote. And so, so as a candidate, somebody goes and they, try to get money, and whoever gives them money in the capitalist system is their boss. Mm-hmm. That's the real world. Whoever pays you is your boss. So then the boss isn't the people. Their boss is whoever gives them money. And so even if they're very intelligent and have a good heart, if they don't do what their bosses want, they won't get the money next time, and then they will lose. Mm-hmm. And because it's cost more and more and more at the federal level, especially to run, you don't just raise some money. You need millions. To run for president, you need billions. And so 6 states already have what's called public campaign financing. And that's where the candidate runs around, gets X number of signatures from their district, and maybe $5, something that most people can come up with. And then the state or the federal has to give them whatever the money they've ascertained. And then that candidate could diss the state or the federal government all year and come back the next time with all their little signatures, and they'd have to get it again. So it makes a level playing field, and it makes for more integrity. And so that's what I am promoting, that I think that's one thing, because until we get the money...
Public financing of campaigns, right?
Yeah, until we get the money out of politics, it's not going to be clean. It's not going to be for the people. It's going to be for the corporations and the financiers. That's just logic.
Mm-hmm. And it's those people with lots of money that we're paying for the Congress people to get rid of the regulations.
Exactly. So thank you so much for joining us here. Again, this is Netra Halperin with Netra's News. Please come watch us again. We'll be live again in 2 weeks, or you can watch the show again in a week, and on Channel 52 and Channel 53 again. So thank you so much. It's been wonderful having Ann and Jenny here in our studio audience. I think it's there's still time to run down to MCC and sign up.
Maui College.
Maui College, and sign up for her class. Wealth of information, and by the end, you will be a scholar in economics.
Economics for real people.
Economics for real people. None of this too esoteric and things that don't even make sense. Economics. I mean, that's money.
Well, it's more than money. It's everything that we live. It's decisions that we make.